So in general, yeah, I think inflation is still not low, but it is somewhere in the ballpark of what they're measuring it to be. Even if there's independent inflation measures like Trueflation, some of them are showing numbers that are slightly below the official averages. And again, that's largely because shelter's probably acting with a lag. So yeah, we are in a what I would consider a genuine disinflationary environment from a high level.
Leading central banks are expected to begin cutting interest rates over the coming year as falling inflation fuels predictions among investors and economists that prices are under control. After entering 2023 amid aggressive interest rate increases, the Federal Reserve, European Central Bank, and Bank of England put their tightening programs on hold in the second half of the year. Now, with headline inflation rates retreating in large parts of the G7 group of industrialized nations and economies slowing, the pressure for policymakers to cut borrowing costs is set to gather strength. Lyn Alden in this video gives her macro view on where we are right now economically and what she thinks 2024 holds for the US economy. Let us now get into the video. Don't hesitate to hit that like button, subscribe, and drop your comments as you watch.
So I think 2023 was a story about fiscal forces and monetary forces offsetting each other roughly equally. And if either one was winning, it was more the fiscal side. And what I mean by that is that throughout 2022, the Federal Reserve, as we all know, was tightening monetary policy. They were raising interest rates, they were reducing their balance sheet, and most assets had a very bad year in 2022. So stocks had a big problem, especially growth stocks. Bitcoin obviously went down a ton. Most other assets did poorly. Normally in those types of environments, bonds hold up pretty well, but even they went down. And so pretty much across the board, if you were not in cash or a small select set of idiosyncratic investments, just about everything went down. But by early 2023, we started to see a little bit of a reversal. In fact, it kind of started in late 2022, which is basically that the Treasury began offsetting some of that Fed tightening. And so throughout 2023, the Federal Reserve has still been tightening. Rates are ending the year higher than they started. The Federal Reserve's balance sheet is lower than it started the year. So the Federal Reserve has, even though they've decelerated their course of tightening, they still are tightening. But what's different about kind of late 2022 and all of 2023 compared to the first 3 quarters of 2022 is that the Treasury is offsetting it, and they've done that in 2 primary ways. So from the fourth quarter of 2022 through the first 2 quarters of 2023, so that kind of 8-9 month period, they were drawing down their cash balance and pushing it back into the market. Partially that was because they had too much cash above their target, and then it accelerated because of the debt ceiling. So rather than emptying some of their cash into the financial system, they had to empty literally all of it up until the end of May of this year. And then the second stage was that the Treasury then had a choice. If they went back to normal operation, you'd have the Fed tightening and there'd be no offset. And we probably would have had a second stage of liquidity crisis. Instead, the Treasury said, okay, we're going to issue a ton of short duration bonds, T-bills, instead of the longer duration, or basically the overall ratio of debt issuance is going to be very much skewed abnormally much towards that short end. And what that did was allowed money that was sitting in the reverse repo markets, which is, for lack of a better word, it's kind of money that's like excess demand for T-bills. It's like excess cash that's sucked out of the banking system. It's kind of parked at the Fed, but not owned by the Fed. It's parked at the Fed. And issuing a ton of extra T-bills allowed that capital to come in back into the financial system. And so that was another lever that the Treasury pulled to offset the Fed's quantitative tightening. And so, for example, bank reserves are not any lower now than they were in the banking crisis. That kind of stress tested their lower end, and almost a year later, 10 months later, bank reserves aren't any lower, even though the Federal Reserve has still been tightening, and that's because the Treasury has used these other offsets to offset it. And so, basically, the story over the past 2 years was, 3 quarters of tightening overall, Fed tightening, and kind of a neutral Treasury, and then about 5 quarters of roughly balanced Treasury and Fed actions. And so various global liquidity measures are higher now than they were in kind of the worst point, which was late 2022. And Bitcoin's price action and many other risk assets price action tends to be highly correlated with global liquidity. And it also just so happens that Bitcoin is, from my analysis, more correlated with liquidity than any other asset that I track.
The U.S. Treasury market posted its first annual gains since 2020, as slowing growth and inflation bolstered views that the Federal Reserve's campaign of interest rate increases is likely over. The result stands in sharp contrast to the market's performance for most of 2023. Benchmark yields were propelled to multi-year highs in October by the prospect that monetary policy would remain tight indefinitely. Growth in the supply of Treasury debt also spurred investors to demand higher rates of return. At its worst point on October 19th, year-to-date losses reached 3.3%. Lyn Alden rates the Fed's performance so far, the mistakes they made, and how they would have been avoided.
I think they're doing a fairly good job, at least in the past couple of years. I think they made missteps in 2020 and 2021 by not anticipating that inflation would come. I think they basically underestimated the quantity theory of money. The supply of money is not the only factor in inflation, but it's a big factor for inflation, and they severely underestimated it. I think their models were wrong, their theory was wrong, and they got punched in the face basically because of it. They got embarrassed. Now, not all the inflation was their fault. A lot of it was the fiscal authority, right? So it's not just the Fed deciding how much money exists. They're working with the Treasury to supply it. So it's not just them that caused it, although they contributed to it. Now, once inflation came, they pivoted and they got very tight, and which is generally what they're supposed to do. In that, they basically wanted to curtail credit growth. They wanted to curtail speculation. They wanted to bring down asset prices, because that helps reduce demand and therefore get back to a supply-demand equilibrium, which can help get prices down. I think the big challenge that the Fed faces is that a lot of this is outside of their control. Their tools are mainly around basically adjusting the level of bank lending. So there's really two main ways that broad money comes into existence. One is very large fiscal deficits are run and monetized by the central bank and the broader banking system. And number two is that banks decide to lend for various reasons. And for example, in the 1970s, most of the money supply growth was from bank lending. In the 1940s and then again in the 2020s, these were other inflationary environments. Most of the new money creation was not from bank lending, it was from monetized fiscal deficits. And the problem is that the Fed has no control over fiscal deficits. Their main tools are kind of built around the assumption that bank lending drives most money supply growth. And so they can slow down the rate of bank lending, which they've done. They can damage the wealth effect to varying degrees and therefore slow down spending, which they've at least for a while it was working. But their tools can't really address fiscal, which is the primary driver of inflation in this cycle. So given the tools they have, they're kind of following the textbook of what they should be doing. So it's hard to give them too bad of a grade, even though I think the whole model is challenged and antiquated. I mean, I really wrote a book called Broken Money to kind of bring attention to how this is very outdated tech. But I guess the people managing the tech are, doing a decent job of it, at least ever since they pivoted.
The U.S. Federal Reserve, European Central Bank, and BOE, along with many of their smaller counterparts, have all held interest rates at what now appears to be their peak since September or earlier. The effects are stark. Housing markets are in a deep freeze, M&A deals falling through, and insolvencies rising. But even before the Fed changed its turn, hinting at its December meeting that it might ease policy faster and further than it had previously signaled, traders had begun pricing in the first interest rate cut. They think that whatever the more hawkish rate setters say now, they will soon feel obliged to loosen policy as inflation eases and the risks of a hard landing for developed economies increase. Higher, but for how much longer, is the question for 2024. What do you think it is going to be? Let us know in the comments section below. Also, don't forget to like, subscribe, and turn on notifications.
Hey Savvy Finance enthusiasts, massive shout out for being the heartbeat of Savvy Finance. Your support has been the wind beneath our wings, and we can't express our gratitude enough. Now buckle up because we've got an exclusive deal just for you. Ever wanted a slice of the action? We're offering a golden opportunity to own part of our YouTube channel's potential future revenue. This isn't just an investment, it's an invitation to be a part of our story. Investing means you're not just an investor, you will be a participant in the future of Savvy Finance. No cheesy lines, just a genuine call to embark on this journey together. But wait, there's more. Your mission, should you choose to accept it, become a Savvy ambassador. Share our videos on every platform: Facebook, Twitter, LinkedIn. Your shares amplify our visibility, potentially translating to more views and more YouTube revenue. Here's the kicker. If our viewership increases, we would not be just growing financially. We would be making a tangible impact by spreading valuable financial education. Now the icing on the cake. Invest and you'll score exclusive access to our private Savvy Finance Discord. Here you can chat with Savvy Finance, swap ideas with fellow investors, and be at the forefront of exciting developments. Click on the link below to register your Gigastar account. You can also find the link to my offering page in the description below. Get your Gigastar account ready, review the offering details, and let's embark on this thrilling venture together. To the incredible Savvy community, thank you for being the backbone of our success. Your journey is my journey, and together, we're creating waves. Cheers.